Hello students, myself Asha Verma. I am from Lakshmi Chand Golwala College, and in today's video we'll be covering a topic, types of mutual fund. So before we will go ahead, let's first understand what is mutual fund. Mutual fund is full of money which is managed by the professional manager. It's like it works like a trust that collects money from the number of investors who share common interest in the objective, and then that full of the amount is invested in the different type of financial instruments like equities, bonds, money market instruments, etc. Now, when we talk about different categories of mutual funds, there are broader three categories of mutual fund: equity, debt, and hybrid mutual fund. In today's sessions, we'll be focusing on different types of equity mutual fund. Now, in different types of equity mutual funds, first we are going to cover basic four types of a mutual fund, which is based on the market capitalization. So, if somebody who don't know market capitalization, a market capitalization of the company is being calculated by multiplying the number of the floating shares which is available in the market with the current market price. Now, based on the market capitalizations of the shares, mutual funds are basically categorized in the four categories. Like number one is multi-cap mutual funds. Okay. Multi-cap mutual funds, as the name itself indicates, if you invest your money in multi-cap mutual fund schemes, the fund manager will going to invest your money in the different equity shares across the different market capitalization. Your risk would be a little bit low because certain share of your investment amount of money would be invested in low risk shares like blue chip companies, that is large cap stock. Certain some of the amount would be invested in mid cap companies, and the certain part of your investment amount would get invested in the small cap company. Like say if somebody wants to take a example of it, there are funds like Nippon India Multi Cap Direct Growth Fund, ICICI Prudential's Multi Cap Direct Plan Growth, Mirai Assets Mid Cap Fund Direct Growth. These are the basic some two or three names I have given you, which are multi cap funds. If you will check, different fund houses have the variety of multi cap mutual funds which you can where you can invest your money. Now, after multi-cap funds, there is another type of fund, that is large cap mutual fund. Now, large cap mutual fund schemes primarily invest your money in the equity shares of those companies whose market capitalization is more than 20,000 crore. Basically, these organizations are like, they are known to dominate the market and they generate steady returns for their shareholders. Like, say, example, companies like TCS, Hindustan Unilever, HDFC Bank, Reliance, etc. Like, if you ask for the examples of these type of funds, so you can take ICICI Prudential's Blue Chip Fund Direct Growth. Then there is Kotak Blue Chip Fund Direct Growth, SBI Blue Chip Direct Plan Growth. Now, here the word blue chip you must be listening again and again. Blue chip means those companies, you can say large capitalization companies are also called as blue chip companies. So basically, here the investments are made in the Nifty 50 companies only. So after multi-cap, we have covered large cap funds. Now the another type of the mutual fund based on the market capitalization is mid-cap fund. Now here in case of mid-cap mutual fund, the equity manager will going to invest predominantly your money in the equity shares with the market capitalization between 5,000 crore to 20,000 crore. Now, these mid-cap companies are ranked from say 101 to 120 depending upon their market capitalization. Okay, like if I have invested my money in a mid-cap mutual fund scheme, they are going to invest money in companies like Mothers and Sumi, Tata Elxsi, Torrent Power, Godrej Industry, etc. If you ask some of the examples of mid-cap funds like Motilal Oswal Mid-Cap Fund Direct Growth, then there is Mirai Assets Mid-Cap Fund, Nippon India Growth Fund, etc. So these are the basic types of mid-cap funds. Now, the fourth and the last one type of a mutual funds based on the market capitalization is small cap mutual fund. As the name itself indicates, the small cap mutual funds manager primarily invests their corpus in the stocks of the companies where the market capitalization is less than 5,000 crore. They are basically going to invest in companies which is pretty small in terms of market capitalization, and their performance would be bit risky. So if the market will outperform, okay, so your investments will also going to outperform, and where the market will fall, you will see the investment, the amount that you have invested in small cap funds, they are also going to, they are going to fall like, drastically, not like a large cap funds where the even if there will also, you will also see that the fall is there also, but then the proportionate of the fall in the investment would be bit less in case of a large cap fund. So if I'm investing my money in small cap mutual funds, those fund manager will going to invest your money in the companies like TV18 Broadcast, APL Apollo, Parag Milk, JP Associate, like that. Say, for example, some of these small cap funds are like Axis Small Cap Fund, Kotak Small Cap Fund, HDFC Small Cap Fund. So these are the basic types of, these are the basic examples of small cap mutual funds. Now, leaving these four which we have discussed based on the market capitalization, mid cap, small cap, large cap, and multi cap, there are certain other types of mutual funds are also there, which are primarily focused in equity. Like, say, example, ELSS is there. Now, ELSS stands for what? ELSS stands for Equity Linked Savings Scheme. Here, when you make investment, this scheme invests in a majority of the fund corpus in equity and equity related investment, equity instruments. But the concern is that, like, unlike the other mutual funds which we have discussed, or which we are going to discuss here in ELSS, there is a lock-in period of 3 years. Now the question comes is, why would even someone will invest their money where the lock-in period is 3 years, especially when you know that your money is being invested in equity market, where you may end up losing your entire investment within just 3 hours also. So 3 years is such a long period. So basically, this mutual fund schemes are meant for the purpose of a tax saving. Here, whatever the up to, say, under Section 80C of Income Tax Act 1961, investment up to 1.5 lakh in the ELSS funds are eligible for the tax deduction. So now you guys must have understood that somebody who is making investment in the ELSS, their primary objective is not only to generate return, or rather, I would say, a profit on it, but also their objective is to, save their taxable income also. So, I mean, to reduce their tax liability. So if you ask me, some of the examples of this ELSS are like, say, Kotak Tax Saver Fund, Mirai Asset Tax Saver Fund, SBI Long Term Equity Fund Direct Plan, etc. So these all are the example of some of the ELSS schemes which are available. Okay. Now the next one is, apart from ELSS, there is dividend yield funds. Now, generally, dividend yield funds are, compared with the growth plans. Okay. Now, the basic difference between dividend yield fund and the growth plan is, somebody who is investing money in growth mutual funds, there your money would be whatever the returns. For example, if I had invested 1,000 rupees, okay, and let's say within 6 months, the mutual fund manager, they have invested my amount in certain other companies, and there I have generated a return of 100 rupees. So the 10% profit is there. So now, instead of taking back those 10%, what that company will going to do is, they are going to reinvest. So now my whole investment would be 1,000 plus 100, that is 1,100 rupees. So that those all are a growth plan. Like, in simple way, if you ask me, growth plans where I'm telling a mutual fund company, whatever the profit you are generating on my investment, keep investing, reinvesting that amount. That's a growth plan. And when it comes to dividend yield funds, where, dividend payout option, where whatever the returns a company is making, or whatever the returns they are generating on the investment, what they are going to do is, okay, they are going to give that amount, whatever the returns they have generated, in the form of dividend to me. So it's like, if you have invested in the FDs, so those who all have invested in FDs must be aware about this. There you get option whether you want to reinvest your interest amount or you want that interest amount to be get credited in your account. So here, in case of growth fund, your returns would get reinvested, and here in case of a dividend payout option, your whatever the returns the company has, mutual fund schemes have generated, that would get that would be credited in your account. Now the next type is dividend yield funds. Now in case of dividend yield funds, the primary objective of the fund manager is to make basically invest your amount in such a such a companies, such a equity shares where the company is known for giving regular dividends to their shareholders. Like say example, Coal India, ITC Limited, Hindustan Zinc, HCL Technologies, etc. If you ask, some of the examples of dividend yield funds are like ICICI Prudential Dividend Yield Fund, HDFC Dividend Yield Fund, UTI Dividend Yield Fund. Basically, the basic objective of these mutual fund manager would be to provide you a regular returns, and that's why they are going to invest in such a company where probably the capital appreciation would be pretty slow, but the company would be paying dividend on regular basis to their shareholders. Okay. Now the next type of a mutual fund is called as sector fund. Now sector mutual funds are those equity based mutual fund where your capital, whatever the amount you have invested, that amount would get invested specifically in one particular sector. Now one particular sector, let's say example, if I am more interested in FMCG sector, so here these mutual fund companies, or rather mutual fund manager, will going to invest my money in those shares which are there in the FMCG sector. Let's say if somebody who is interested in making investment in automobile sector, so these mutual fund managers will going to make investment, they are going to invest your money in mutual companies related within the automobile sector only, like Tata Motors, Maruti, Honda, like that. Fine. Like these basically, when you make investment in sector specific funds, so I mean, if you ask me which type of investors basically invest in such sector specific funds, who have a concentrated interest in specific sector only, they don't want to divert their attention in the different industry. Probably they will have more faith on that industry, or maybe their keen interest is there in that industry only. Of course, if you ask me the percentage level of the risk involved in that, sector mutual funds are pretty more risky, because here your investment, the entire investment is concentrated on one particular sector only. So that is pretty risky. If let's say if one sector doesn't perform well, so then there is no option of diversification. Here the diversification will only going to take place in case of a different companies in which they are investing. But like industry, what if the whole industry is not performing well? In that situation, you won't have any objective of, I mean you won't have any option of diversification in your investment. So this is sector mutual funds. Like if you ask me, some of the example of sector mutual funds are like ICICI Prudential, diversified funds, etc. Okay. Now the other next type is contrast mutual fund. Contrast mutual fund are, you can say, that's pretty technical to understand. Like contrast mutual funds are specialized form of a fund that takes advantages of underperforming companies or enterprise. So basically, in a contra mutual fund, the fund manager will going to invest against the existing trends and purchase the stocks which are not performing well, which they have a confidence will going to perform well in the future. So probably at the initial stage, you would see that these companies are, if the market is moving up, probably you would see that these companies are not moving up. Okay. But when the whole market will start performing, start underperforming, then you will see that the returns on these mutual funds are flourishing like anything. So basically, It's like they basically invest in opposite to the normal equity market, or in the that's another way of basically a diversification where I'm going to invest. Let's say example, when we say one should invest in gold also, one should invest in equity market also. The general tendency of the market says that when the equity market will be growing, the probably would see the returns on gold would be little less, correct? And the vice versa of that, if the gold is moving up, the probably would see that equity market is not doing that well. It's that sort of investment, so that when the entire market is not doing so well, in that situation, these contra mutual fund will be giving you returns over a period of a time. If you ask, some of the examples of contra mutual funds are like SBI Contra Direct Plan, then there is Kotak India EQ Contra Fund, Invesco India Contra Mutual Funds. These are the basic example of some of the schemes that I have named here. Of course, if you will see, there are a number of contra mutual funds are available for making investment. And the last type of mutual funds which I'll cover is value mutual funds. Now, value mutual funds are those type of equity mutual funds where the fund managers adopt value investing strategy. They basically invest in the stocks that trade at discounts. That's basically their intrinsic value is higher than the marketplace. Like say, if the stock has a potential to reach up to rupees 100, but at present that is available in the market at the discount rate, say probably 60 rupees, 40 rupees. So value mutual funds, those fund manager will be concentrating on such a shares which have a great growth potential in future. These basically shares are usually undervalued due to the temporary reason, maybe something had happened in the management, or some due to maybe any domestic factor, or maybe any international factor, and because of which you will see that these shares are presently down performing. But over a period of a time, the fund manager or the stock has a potential, fund manager has a confidence on that share, even the stock or the company has a potential to grow over a period of a time. Like say, when the Cyrus Mistry has taken exit from Tata Motors, then during that period of time, you would have seen the Tata Motors have fallen like anything. But those people who had a confidence of that company in that company, they kept their investment there because they were like, okay, it's Tata Motors. Though the problem is there and the stock is falling, but over a period of a time, the company will going to come back again with that same intensity, and that's what we are seeing in 2023. That's what has happened, correct? So these are such an investment are called as a value investment. So if you invest in value mutual fund, of course that would be a bit risky, and probably it would take some times to get returns on that investment. But over a period of a time, you would see, though the risk is high, the returns would be a bit higher than the other mutual funds. If you ask me, some of the examples of these value funds are like, say, ICICI Prudential Value Discovery Growth Plan. Then there is Tata Equity PE funds, HSBC Value Funds, etc. So these are the basic examples of value mutual fund. Okay. So in today's video, we'll just do a quick revision. What we have covered, we have discussed about mutual fund, and in that mutual fund, we have just covered certain types of equity mutual funds where your whole investment amount, your whole amount is being invested in the equity market based on your objectives. Okay. If somebody who is interested in further studies, I'll give you the source also. One can refer the websites like www.amfindia.com. Then there is website like grow.w.in. Then there is mutual fund sahiha.com. These are the three basic websites where you can find. Of course, I have covered only equity mutual fund. There, if you visit these three websites, you will get in detail information about these mutual funds with examples, and there would be certain videos are also available. And even if you are more interested in knowing, we have covered only equity fund. If somebody is interested to know about hybrid and debt funds also, on that website, these websites, you will get information about those mutual funds also. And if you guys are interested reading books about it, So there are certain academic and non-academic books are available. Like academic books, there are mutual fund management textbook is there by Whipple and Shade Publications. So those students who would be interested reading these books, they can refer it. And some of the non-academic books are also available, like Indian Mutual Funds Handbook by Sundar Sankaran. There is a Mutual Funds in India book named Mutual Funds in India by Rakesh Kumar. And there's one more book, Mutual Fund Investment by Anil G. Dane. And the simplest one is NISM Series 5 Mutual Fund Distribution. This book is specifically meant for those students who are chasing the certification exams in mutual fund. So the idea behind covering this topic in this mutual types of mutual fund in this particular video is because those students who all are there in the SYBAB, because in SYBAB they have a subject financial market operation. So in their subject, they have a specific topic related to mutual fund. Not only this, the students from TYBMS Finance, they have a subject with the name investment analysis and portfolio management. In their subject, they have one particular topic related to mutual fund. In fact, TYBBI and TYBAP students are also there who have a subject security analysis and portfolio management. Even they have one topic related to mutual fund. Not only this, SYBBI and SYBIM students, for them to mutual fund management itself is a subject for them. So they have the entire textbook to read about the mutual funds. So for that reason, I have covered this type of mutual fund in this video. Thank you so much, everyone.